Everyone loves to talk about yield. I care about something different. Is my income actually growing? Today I'm pulling up every chippy payment since I started investing, and the results honestly surprised me. So stay tuned. Welcome back to Simply Money. One of my favorite things about investing isn't watching the portfolio value bounce around every day. It's watching the income grow month after month. Today we're looking at 7 months of real chippy payments, from $906 in November all the way to $1,866 in June. We'll walk through every monthly distribution, calculate the growth, talk about why some months were higher than others, discuss whether this pace can continue, and most importantly, whether Chippy still deserves a place in a long-term retirement income portfolio. If you're building an income portfolio designed to pay you without constantly selling shares, I think you're going to enjoy this one. And make sure you stick around until the end, because I'll show you the average monthly growth rate, whether I think this income trajectory is realistic going forward, and exactly what I'm doing with every dollar Chippy pays me. Let's dive into the video. The first thing we're going to look at, and many of you may have seen this before, I use this on my monthly income portfolio updates. And what this is, it's my Simply Money dividend growth tracker. I have one of these for each one of my holdings, and this is the chippy one. And what I do is I put in the date I bought it, how much I put into it, what the price was, and how many shares. Now, I did a couple buys within a few weeks, so I took my average cost and the amount that I bought into it, and it does include a few of the drips early on. So I started this from after my final buy. So this is pretty close to the exact amount, but it's going to be slightly off. I just did this for ease because of some of the buys throwing it off. So please bear with me on that. But what we have over here is you have the date each week that the dividend was paid, and then it shows what the dividend per share amount was. We'll go through that here in a moment. Then how much the dividend amount was, because it's based on how many shares I own. And I am fully dripping currently, and I have been since I bought this, and will continue to do so for the near future. I am looking at possibly changing that, but I want to show you at the end a reason why I may not. Stay tuned for that. It shows you what the price was when I bought the new shares with the distribution, how many shares I was able to get with that distribution, what my new share count is, and what the total value is. As we come down here, let's look at the dividend per share amount first. I just want you seeing that each week it was paying 40 cents, 43 cents. As you come down here, I think this is the lowest one we're looking at here in December. It got down to 37 cents, but the payment was still $200 that week, where my first payment here was $198. Even though the distribution per share was down a little bit, the total distribution was still up, because at this point I had gained about 45 shares by buying more. So that's one of the reasons for dripping as I'm building and accumulating this position. Again, that's about $24,000 initially invested. It was paying me $200 or more a week. As we come down here to the most recent, so just look at June, you can see these payments in the 60 and then 70 cent range each and every week, and giving me payments of $458, $402, $494. Then our highest payment ever, the $511. Then July's first payment is down a little bit, and we'll look at that. And I want you to pay attention to this, because this is important. A lot of people might be looking, saying, oh, see, they dropped the dividend again. It's going down. It's tanking. The NAV's going down. Look at that. It's down $7. All these things create fear. And you have to look at it beyond, is the market going down? Are the underlying stocks going down? Or is it truly NAV decay? There is a difference. I'm going to show you a couple different tools I use for monitoring this and how I make some of my decisions. But just coming down here to give you a quick overview, the $24,000 invested, I've accumulated about $12,000 in distributions, which have bought more shares. The share price itself, even though it's down $7 right now from last week, about $9 from its high, it's okay. It's still up 56% in the 7-month period. So I'm okay with that. This isn't NAV decay. And this is, for those that don't know, CHPY is an ETF with 30 companies that are in the semiconductor sector. So all of the companies are focused on semiconductors. And I believe the semiconductor world is going to continue to be very important with the AI boom and everything going on for the near future. Again, in technology, that might be 5 years, it could be 10 years. We don't know. I will monitor it. These types of funds for me, unlike something like SCHD or the S&P 500, this isn't a buy and hold, set it and forget it type fund for me. This is a fund I'm watching, and I'll continue to monitor it and use the tools I have at my disposal, and I'll make a decision at some point. Do I want to get out? Do I want to change from drip to taking cash? How do I want to deal with it? I will monitor it. This is not a buy it and then hold it for 30 years, don't pay any attention to it. A difference between some of the other funds that I do hold. You can see that the total shares, we're now up to 671. We've gained 185 shares. Think about that. Just that alone, you've gained 185 shares, and the starting shares have appreciated 56%. Now, these shares have appreciated at various levels, depending on when I bought into them, and our total share count, again, is 671. Our total gained value is $28,000. So my unrealized gain at 7 months in is 116%, $28,000. I have basically doubled my money, a little bit more, in 7 months. So if I wanted to, I could sell out of this position and take the realized gain and deploy it somewhere else. I don't feel like it's time. This is my opinion. Again, this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know that all investments come with risk, and losing principal is one of those risks. So know that beforehand, and please do your own due diligence. But if I wanted to, at this time, I could sell out of this, or I could sell $24,000 worth. I'm still going to have $28,000 in there working for me. And my original capital from 7 months ago, I could put back into a growth fund or some other fund that I feel safer about. But again, I don't feel it's time. And again, that is my opinion. I want to show you a couple things here. First, we're going to look over here, just a quick table. You can see the income each month. I want you to notice that even though it went down 19% this month to that month, October to November, and then November to December, it went down another 3%, but then it went up 55%. Now, I want to make note, part of that is there were 5 weeks in this January payments, or 5 weekly payments, so that's part of why that went up. And then it went down slightly in February, down 13%, and down again 10%. And this is where people will be like, wait a minute, maybe early on here you're like, I'm out of this, I'm losing money. But if you believe in the underlying funds, you believe in the process and the methodology being used, some dips are okay. Just like the S&P 500 may dip, but long term it goes up. I still believe I have to watch this. This isn't, again, a hold it forever, and I'm monitoring it, but I'm looking at the principles, and are the principles holding up? In my opinion, they are. You see, in April, it went up 45%, then up again 7%. And then in June, 14%. Total growth month over month of my income has been 65%. So I went from $1,100 in October, $900 in November, to $1,600, and then almost $1,900 in June. You can see the dividend per share chart, how that's been going up. And yes, there are some down momentum here, and then it goes back up and some down, just like the stock market. This is okay to me. This is part of it. If you look at the total payments, and again, you have 5-week period here in January and again in April, so those are higher. And we'll look at the weekly here in a moment as well. But from the beginning to the end, our trajectory is good. I am happy with that. That is one of the things you want to look at. If you look at our starting weekly income of $198, our ending weekly income of $444, that's a $245 a week increase, or a total growth of 123%. 2%. That averages out to 2% per week growth on your income. And for somebody who's looking for income in retirement, to me, that's important. I want my income growing. I want to be able to keep my spending power and keep up with inflation, if not exceed it. 2.08% per week far exceeds inflation. Now, I want you to look at this chart. This is the weekly payment chart of CHPY. Every week, what it paid, and you can see here, people will be excited and thinking, oh, it's going up. Then they start getting nervous, but that's part of it. And this is why I don't judge an income investment by 1 week's payment. Some weeks are lower. Some are higher. When you zoom out, my weekly income has grown from about $199 to $444. That increase of 123%, that's the trend I'm focused on. Just a few highlights. The highest payment, $511. The lowest payment, $198. Current payment, $444. Growth from first to highest payment, 157% up. And current payment versus high payment, that is down 13%. If you look right here, I'm not worried about this was our high last week, and this week it was down. I'm okay with that. That is part of it. Just like here, we had a high and it dipped, but then it went higher. We had a high and it dipped. We had a high here and it dipped a couple weeks. Then it went back up, dipped a little bit. Way back here, we had a high. It was down for a little bit, then we had a nice wave up. That's because semiconductors are extremely volatile. The underlying funds are going up and down, and they are looking to pay that yield based on whatever the price is. So if the price goes down, the yield percentage stays about the same, but as the price goes down, they pay a little bit less. As the price comes up, they pay a little bit more, but the yield stays about the same. Unlike SCHD, for example, it's about a 3.5% yield. If the price dropped in half, that yield would spike, so they'd be paying like 5%. If the price doubled all of a sudden, the yield would drop down to maybe 2%. They're not looking to keep the yield the same. The underlying funds are paying a particular dividend, and the yield just fluctuates depending on the price. Where this type of fund with CHPY, the price and the yield stay about the same. They follow one another. So I'm looking at the underlying stocks. I'm looking at the underlying companies. Are they having issues, or are they just following the stock market? For example, right now it's down slightly because there's certain news that took place. They're talking about different news cycles that create either hype or fear, and those are just following that, and that's normal. This is not NAV erosion in my opinion. So that is what I look at, and why 1 week to the next isn't my determining factor. What I do want to show you is a couple tools I use. The first one I want to show you is the Simply Money drip score. For those who have not seen this, this is an individual drip sheet, and I have it for CHPY here. Again, I have the date I bought into it, the price, and this is automatically populated based on the date you put here, how many shares my money would have gotten me. So again, because I did some dollar cost averaging on those about 3 or 4 buys over a couple weeks, the price is slightly different from the actual price here, but it's very close. Again, what this does is it populates exactly how much the stock price was, what the dividend amount was, and whether you dripped fully, 50-50, or no drip, what your results would be. Now, I've been doing full drip, and I just showed you that here on the other sheet, which all of these sheets are available at Buy Me a Coffee in the description below. There's a link down there where you can get all of these sheets as well as some of our other tools. But this is great for looking and saying, historically, how would I have done? Would I have done better dripping or not dripping? You can even come over here and say, what if I took 25% and dripped it and kept the rest? Or maybe I do 40%. You can change this amount right here. Or you could say, what if I took $400 and I dripped the rest? So you could go ahead and put that in there. Obviously, at this amount, that probably wouldn't be the best idea, but you could put that in there as well. You can put whatever amount you want. But you could see, if we come down here to the final, if we did a full drip, 50-50 drip, and no drip, what our total returns would be, because you take in what is the price appreciation of the portfolio and how much distribution. So if I did a no drip, I would have received about $9,000, and my portfolio would have had an unrealized gain of about $10,000. So what this does, and this is one of about 100 tickers on this drip score sheet. Those that have bought this have given me a lot of feedback that they really love how this works. What it does is it takes all of these individual drip sheets, depending on the date you put, and then it fills this out. And we'll look at CHPY right here. Shows you what company it's from, shows you the price appreciation from the date that you put in on the individual sheet, what the total return was for full drip, 50% drip, no drip. Then you have your yield on cost, what the average yield is. But here's where the sheet really comes in handy. Over here, you have your drip score. And what this is showing you historically, based on the date you put in there, were you better off taking the income or dripping it? If it is green, it means dripping, reinvesting, did better. And this percentage shows you how much better it did. Now with CHPY, you did fine any way you did it, but if you're looking for total return, dripping historically from the date we have in there did better. Now the income versus decay ratio, what this is that lets us know there's been no decay. Purple 999 means that the NAV has actually appreciated. You have other scores here where the NAV has gone down, but green means that it has gone down less than the yield. So the yield has been able to, the income versus the decay has been good, meaning you've gotten more income than the decay of the NAV for the period we're looking at. Where you have something like here, BTCI, meaning the distribution's been paid out, but it hasn't kept up with the NAV. So the NAV is actually lower. And you can see your total return yield with drip is down 10%. You did worse dripping. You would have been better off taking cash. And here's a new part for some that you may not have seen this yet. It's the drip opportunity. And again, we'll go to CHPY because that's what we're focused on. It shows that it has a drip opportunity of 94 and it is opportunity rank elite, meaning that if I was to buy this and I have the income, what is my drip opportunity right now based on the trend that it's been going through over the last 12 months or 6 months, depending what date I put in there? How is the trend going with yield, with the NAV? Is this something that's worth dripping into, or should I look at taking the cash or possibly getting out of it? This tells me this is a great drip opportunity because the total return is very strong. The yield is very strong. And so that lets me know that I would look at getting this distribution and dripping it. And that's what this sheet will do. This has, you can see all the tickers here, 100 different sheets, a couple more actually, that you can go in. Each one of those you can go in and put in the date that you want to test it from and how much. The price doesn't change the results. It just changes the results down here on the dollar amount. But your percentages, your drip score, your income versus decay ratio, and drip opportunity are not dependent on how much you have invested. It's strictly on the past performance and the current trends, how it's performing. So I track my individual tickers on the sheet, the dividend growth that I showed you at the beginning. I use the drip score sheet here to help me make determination of what I want to buy into. And then when I'm holding something, to watch the drip opportunity, do I want to drip this or maybe I start taking the cash? And then I have this here. Many of you, this is probably the fan favorite. I've had a lot of people buy this one and use it and give me lots of feedback. This is the portfolio planner. And you can pick all the different tickers you want to set up a portfolio on and decide how you want to allocate it. What I'm doing here, just to demonstrate with CHPY, I have CHPY set with 100% of the allocation. So we have $52,500. That's my current balance based on what I initially invested, dripping, where I stand today, approximately how much is in there. If I kept that in there and I put it on the manual 50th, if we get a average return for the next 5 years, and see over here, I set it for accumulating for the next 5 years, not adding anything to it. I'm just letting it drip and letting it reinvest. What would it look like? You can see I have the deposit rules, nothing set there. I have the withdrawal rules, nothing set there. But you come over to the forecast, I have it set on conservative, because that's where I have this example set up. And you can see at the end of 5 years, so I'm 57. In 5 years, let's say I retire at 62. If I decide, okay, I'm going to retire then, this is what I could forecast my CHPY, if it continues in a moderate outcome for the next 5 years, I would expect it to be about $184,000, producing about $3,400 a month. That's double what it is currently right now. Yes, it has doubled in the last 7 months. I don't expect that for the next 5 years, even if it slows down tremendously. Let's look at it. If we go over here to the portfolio engine and we put it to historical, and this is still conservative compared to what it's actually done, but if we put it on historical and we go back over to there, you can see that it's forecasting $235,000 with $5,500 a month income. I don't think it's going to sustain this historical 7 or 8 month period for 5 years. So I put it on the manual, kind of middle of the road, what I could expect, and that is what I could be looking at. Now, doesn't mean it's going to be what it is. I may have to sell this. I may have to start taking the cash. Again, I will be monitoring this, unlike other funds that I just set it and forget it. This one I'm keeping an eye on, and I'm okay with that. That's part of what I'm doing. But if this fell in the middle of the road for the next 5 years, that $24,000 I invested, which is now $52,000, could technically grow to $184,000 that is producing $3,400 a month. I would be extremely happy with that, even if I sold it then and rolled it into something else, or if I turn the drip off, maybe I take out 50 grand and I keep some of the cash in here. Whatever I do, I don't know. I'll keep you posted. I'll have more updates. But this is the portfolio planner. You could put 10 funds in here. You could put different allocations and change it around from conservative to moderate to aggressive. And you can see different outcomes. And you can even add how much you want to add to it a week or month and put that in here. You can take, okay, after 5 years, I'm going to start withdrawing money. What would that look like? And you can do different things like that. Over on the Forecast Pro, you can actually come up here and you can turn this redirect income to yes. And then you can set, maybe I want Chippy to go to DGRO, so I'd set this to 100%. So I'm going to take Chippy's income and it's going to redirect it into here. So there's a lot of different things you can do with this to kind of forecast out what you're going to do. These are some of the favorite tools on the channel down at Buy Me a Coffee and the link below in the description. That is it for today. That is my Chippy outcome. What are your thoughts on it? Do you own Chippy? Are you into Chippy? Thinking about getting into it? Do you take the distribution as cash? Do you reinvest it somewhere else? Do you reinvest it back in? Leave me your thoughts down there. Have you heard of Chippy before? I've actually had some people who haven't heard of Chippy. And this is why I share this. Not telling you to buy it, not buy it. What I do is personal for me. Personal finances are personal. You need to make your own decision. Do your own due diligence. I share these, not only what I'm in, like Chippy, but I also share other funds that I'm not in to provide the data, show the historical data, what people think the forecast might look at, which is all projection. Nobody knows. And I provide that for you to make informed decisions. I hope you like these. Leave me some comments down below. A lot of people ask, hey, Ken, how can we help your channel? Obviously, buying the sheets is a tremendous help. It helps fund the different things we need to continue to build the channel, to do some editing, to buy some of the tools we need. That is very helpful. But the best way you can help, hit that like and subscribe button. Hit a hype down below. You can hit hype this video. Leave a comment. Share the video on your social media. All those things. Tell YouTube, hey, I like this video. You need to share it with others. And so you're sharing it and commenting really helps the algorithm say, hey, we want to get this out to other people. If you want to help the channel, that's the best way you can. If you don't want to help the channel, no pressure. I appreciate you watching. I appreciate your being here, and I hope this is helpful for you. And I will continue to do this whether you like it or subscribe or not. This is why we're here. Thank you for joining us. That's it today. We'll see you next time on Simply Money.